The End of Neutral Global Finance and the Rise of Economic Power Blocs. Section 1. Thesis. Neutral global finance is ending. What once appeared to be an open, rules-based system of cross-border payments and capital flows is revealing itself as strategic infrastructure, subject to control, coercion, and geopolitical leverage. The use of U.S. secondary sanctions, capable of targeting trade even outside the dollar system, has exposed a core truth: access to financial rails is conditional. In response, nations are building parallel systems, not for efficiency but for survival. The result is a transition toward fragmented economic power blocks, where sovereignty takes precedence over scale. Section 2. Grounding. How the system actually works. The modern global financial system has been built around U.S.-anchored infrastructure, dollar settlement, correspondent banking networks, and deep capital markets. For decades, this created the appearance of neutrality. Transactions could flow across borders with relative ease, cost efficiency, and legal predictability. But this neutrality was always contingent on alignment with the system's core gatekeeper. U.S. sanctions policy, especially secondary sanctions, demonstrates that control lies not just in currency but in access. Even when transactions occur entirely outside the dollar, entities involved in targeted activities such as Iranian oil trade can be cut off from the broader financial ecosystem, denied banking relationships, excluded from capital markets, or sanctioned outright. This transforms financial infrastructure into a tool of statecraft. Participation is no longer just economic, it is political. Section 3. Catalysts. Why the shift is accelerating. Now, several developments have accelerated the breakdown of the old model. Sanctions escalation. Repeated use of financial sanctions against countries like Iran and Russia has demonstrated the reach of U.S. influence beyond its borders. The signal is clear. Independence in trade does not guarantee insulation from enforcement. China's strategic response. As the world's largest commodity importer, China has increasingly settled trade in yuan and expanded alternatives like the cross-border interbank payment system. Yet even these measures have not fully shielded its firms from external pressure. Multipolar tensions. Rising geopolitical competition has eroded trust. Nations are no longer comfortable relying on infrastructure controlled by strategic rivals. Technological capability. Advances in payment systems, real-time domestic rails, digital currencies, and blockchain-based solutions have made it feasible to build alternatives where previously none existed. These forces converge on a single realization. Dependency on a single global system is a strategic risk. Section 4. Real-world stakes. For nation-states, countries are increasingly prioritizing financial sovereignty. India has expanded UPI beyond its borders. Brazil's PIX has transformed domestic payments. Africa is developing the Pan-African Payment and Settlement System, PAPS, to reduce reliance on external currencies. Europe is exploring alternatives to U.S.-controlled card networks. Russia and China have built their own messaging and settlement systems. This is not coordination, it is duplication. Each system exists to ensure continuity in a worst-case scenario, exclusion. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Real-world stakes continued. For global markets, fragmentation introduces friction. Multiple systems mean higher costs for compliance, currency conversion, and integration. Liquidity becomes segmented. Capital flows are less efficient. Trade continues, but with increased complexity and reduced transparency. The global economy shifts from a unified network to a patchwork of semi-connected systems. For the Global South, the burden is disproportionate. Developing economies rely heavily on low-cost, accessible financial rails for trade, remittances, and investment. Fragmentation raises barriers to entry, higher fees, reduced access, and increased volatility. The very regions that benefited most from financial globalization are now most exposed to its unraveling. For corporations, businesses must navigate multiple systems simultaneously, managing geopolitical risk alongside financial operations. Smaller firms lacking scale are particularly disadvantaged. What was once a standardized global environment becomes a fragmented operational landscape. Section 5. Contextual clarity, efficiency versus sovereignty. At the core of this transition is a trade-off. Efficiency, a single integrated system, offers economies of scale, lower costs, faster transactions, and global interoperability. Sovereignty, independent systems provide resilience, protection from external control, sanctions, and exclusion. The old system optimized for efficiency under the assumption of neutrality. The emerging system optimizes for sovereignty under the assumption of risk. This shift is driven by a loss of trust. Everyone is afraid that a competing payment infrastructure will be weaponized against them. That fear is rational. Once financial infrastructure is used as a tool of enforcement, it ceases to be perceived as neutral. Participation becomes conditional, and dependency becomes vulnerability. Section 6. What comes next? A layered financial world. The future is unlikely to be a clean replacement of one system with another. Instead, a layered structure is emerging. The dollar system, still dominant with unmatched liquidity and global reach. Regional systems, national and block-level payment networks designed for internal resilience. Bridging mechanisms, bilateral agreements, currency swaps, and emerging technologies, including stablecoins and tokenized assets, that connect fragmented systems. This is not deglobalization. It is reconfiguration. The world moves from a single operating system to multiple interoperable environments, each with its own rules and constraints. Section 7. Conclusion. Neutral global finance was never truly neutral. It was stable because it was uncontested. As geopolitical competition intensifies, that stability is breaking down. Financial infrastructure is being reclassified from shared utility to strategic asset. The result is a more fragmented, more complex, and more expensive system, but also one that reflects the realities of a multipolar world. The question is no longer whether the system will fragment. It already is. The real question is whether the emerging network of economic power blocks can coexist without turning financial infrastructure into a permanent battlefield.